On this video of the Bedroom Investor Stock Valuation series, we will be discussing what is the price-to-earnings to growth ratio and how we can use it to value the stock of a company. So, what is the price-to-earnings to growth ratio? Also known as the PEG ratio for short. Well, first let's consider a company. It could be any company. The PEG ratio is when you take the price-to-earnings ratio of a company and then divide it by the earnings per share growth rate of the company. The PEG ratio is a tool that is used by investors to help them assess the value of a company, and it is a more powerful tool than the standard price-to-earnings ratio, as the PEG ratio not only helps investors determine a stock's value, but it does so by factoring in a company's expected earnings growth. The PEG ratio paints a more complete picture of a company and gives investors a better idea of what they are paying for compared to the standard PE ratio. Let's consider a hypothetical company, in this case Ann's Coffee Shop. The price-to-earnings ratio of Ann's Coffee Shop may be low and seem cheap. However, if you were to consider the earnings growth rate of the company and consider the price-to-earnings to growth ratio of Ann's Coffee Shop, the stock may not look so cheap anymore. The price-to-earnings to growth ratio is a ratio in which the lower the value of the ratio, the more undervalued the stock may be. Different companies in different industries have different average PEG ratios, as different companies in different industries have different growth rates, and the degree to which a stock is under or overvalued depends on which industry the company is in. According to one of the most successful and well-known investors of all time, Peter Lynch, says a company's price-to-earnings ratio and its expected growth rate should be equal, and this suggests that the company is fairly valued. When the price-to-earnings ratio of the company is equal to the expected growth rate of the company, the price-to-earnings to growth ratio computes to be 1. When a company's PEG exceeds 1, it's considered overvalued, while a stock with a PEG of less than 1 is considered undervalued by investors. So, how do we calculate the price-to-earnings to growth ratio? We already know the formula for the ratio, which is where we divide the price-to-earnings ratio of a company by its earnings per share growth rate. But let's do a calculation with actual numbers. The numerator of where the price-to-earnings ratio is, we won't go through the calculation, as we have already covered this topic in another video. The link to the explanation and calculation of the price-to-earnings ratio will be in the link in the video description below. As for the expected earnings per share growth rate of the company, you can either look up the analyst estimates for the company, or you can estimate it yourself. Let's look at Ann's Coffee Shop, which has a price-to-earnings ratio of 10 and an expected earnings growth rate of 2%. Plugging these numbers into the PEG equation gives us 10 divided by 2, which computes to be 5. So the PEG ratio of Ann's Coffee Shop is 5. But please remember, as with any ratio, the accuracy of the PEG ratio depends on the inputs used. When considering a company's PEG ratio from a published source, it's important to find out which growth rate was used in the calculation, as this will determine how relevant and useful the PEG ratio is for your stock analysis. As we have just discussed, the accuracy of the PEG ratio depends on the inputs used in the PEG equation and how accurate and reliable they are. And when an investor decides to use the expected earnings growth rate from a published source, the investor must do their due diligence to find out how the analysts came to their growth number and see if it makes sense. The PEG ratio can be calculated for the 1, 2, or 5-year period into the future. But remember, the further you go out into the future, the more likely your estimates will be wrong. Also take note that the historical earnings growth rate is not equal to the future estimated growth rate, as business conditions and dynamics are ever-changing. And lastly, the PEG ratio can be differentiated by the trailing PEG, where historical earnings growth rates are used in the PEG equation, and the forward PEG ratio, where the estimated future earnings growth rate is used instead. Let's see how we can use the price-to-earnings to growth ratio to compare two companies. We will consider two hypothetical coffee shops, Ann's Coffee Shop and Emily's Coffee Shop. Ann's Coffee Shop has a price-to-earnings ratio of 10 and an earnings growth rate of 2%, and for Emily's Coffee Shop has a much higher price-to-earnings ratio of 60 and an earnings growth rate of 30%. Using the PEG equation, where we divide the price-to-earnings ratio of a company by the expected earnings growth rate of the company, Ann's Coffee Shop has a PEG ratio of 5, whereas Emily's Coffee Shop has a PEG ratio of 2. We can see that even though initially, when just considering the price-to-earnings ratio, Ann's Coffee Shop looked cheaper than Emily's Coffee Shop. However, in terms of the PEG ratio, Emily's Coffee Shop was the cheaper stock when you factored in the two companies' earnings growth rates. The price-to-earnings-to-growth ratio is a ratio in which the lower the number the better, because the stock is cheaper. For a company that generates positive earnings, a lower PEG ratio means the investor is paying less for per unit of earnings growth. A PEG ratio that is less than 1 is favored by the majority of investors, as it signals that the stock may be undervalued. What does a negative price-to-earnings-to-growth ratio mean? A negative price-to-earnings-to-growth ratio can result from a company either having negative earnings and/or a negative estimated growth rate. In either case, this suggests that a company may be in trouble, and investors should be careful and make sure that they do their due diligence in their research. If you found this video useful and gained value, then subscribe to our YouTube channel, as we plan to release more videos in the future, where we look into depth about various financial ratios and learn how to analyze financial statements. You'll also receive notifications for when the videos are uploaded. Our goal is to make everyone around the world a better, smarter, and a more confident investor. So please share this video to someone you know who will gain value from this video. Thank you for your help in helping us achieve our goal. We'll see you again soon on our next video. Until then, happy bedroom investing.